Welcome to the AWA Market Minute, breaking down financial, political, and economic events that impact today's retirees. Our investment committee performs hours of research and market analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring top industry experts who share insights on important topics so that our clients can gain understanding and peace of mind on their journey to and through retirement. And now your hosts, Chief Investment Officer Scott Hoxer and Founder and CEO Paul Coles.
Well, hello everyone. Welcome to our first episode of 2026 AWA Market Minute. Scott, how are you?
Doing great, Paul. Happy 2026.
We're right back into it. And as we head into this new year, markets are once again facing a mix of opportunity and uncertainty. But instead of trying to predict outcomes, Scott, I felt like today maybe we could spend more time focusing on kind of what are some of the right questions that our clients and all investors should be asking as they kind of think about 2026. But before we dive into those specifics, Scott, when you step back and look at the markets heading into 2026, what kind of feels fundamentally different, but what feels very familiar?
Yeah, so in terms of what feels familiar, going into any year, Paul, the odds are still stacked in the market's favor. Markets are right more often than they're wrong. The historical statistics show that 3 out of every 4 years on average, markets are up rather than down. And so we have that kind of historical weight, and the dice are loaded in any year that we start for markets to be up rather than down. And some of the things that feel normal is the U.S. economy is a vibrant, robust thing that just plows forward in spite of whatever else is going on in the world. And I don't think that's any different this year. I think as far as what's maybe different and things to highlight, we've had a strong market cycle over the past several years. So a lot of asset values are relatively high. We have a new kind of global regime as far as tariffs go and international trade. That's still kind of being settled out. That's by no means kind of worked its way through the system. And so we're waiting to see how that will align. And then global conflict does seem unfortunately elevated. Global conflict unfortunately is always with us, but at this particular juncture, it does seem more elevated than what it has historically been. And so, some of those fundamentals remain the same, but I think there's some nuances to consider for 2026.
No, that's interesting, and I know we're going to dive into some specifics on some of those those points there with global conflict. I think we talked about this earlier, but like there's this interesting dichotomy today between kind of where the market might be and kind of how people are feeling about that market, and they're not; those two things aren't always aligned. So Scott, maybe show us on this slide here, kind of what are we looking at?
Yeah, so this is an interesting, this is a relatively new data point, and it's awesome. So this is called GDP Now. So this is published by the Atlanta branch of the Federal Reserve. And so what they do is they make a real-time estimate as to how the economy is performing at a specific point in time. And so this most recent print that we have showed economic growth at 5.3%. For a developed and mature economy like the U.S., that is a big number. The economy is running very, very hot right now. And a little bit of that is statistical noise. As I mentioned, the tariffs and the trade wars and all that is still working its way through the system. And so some of those inputs are dictated by global trade flows, and some of them are going to be temporarily high and won't always be at that point in time. But regardless, the economy is doing extremely well.
Yeah, so when you see a 5.3% GDP growth, the expectation is everything's moving along quite nicely. We are producing and selling those goods quite well. And in spite of that, Scott, explain this next slide.
Yeah, so this is a super interesting dichotomy. So this slide that we're looking at, this is the University of Michigan Consumer Sentiment Index. And so this is the most widely respected measure of consumer sentiment, how people feel about things economically. And you can see kind of where we're at this juncture we are at or near all-time lows as far as how pessimistic people are feeling. This data set goes all the way back to the 1950s, Paul, and you think about everything that's happened since then. You look at 1980, for example, when we had sky-high interest rates and inflation and slow economic growth, the kind of long-term hangover after the Vietnam War. That's how people are feeling today. And so there's this weird, as I mentioned, dichotomy where stock markets are at or near all-time highs, economic growth is surging, yet people feel pretty grumpy and pretty pessimistic about things.
Yeah. Well, let's try to dissect it and figure out maybe some of the psychology as to why. So maybe the first area I'd like to get into, Scott, is this whole notion of AI, and we hear this all the time with our clients. Some people are extremely excited about it, and other people are very, very pessimistic and just kind of like leery of is it really going to turn into something? And it's clearly been one of the dominant drivers of market performance. From your perspective, what makes this AI cycle maybe different from past tech booms?
Yeah. So I think the biggest fundamental difference today, Paul, compared to like the 2000 dot-com bubble, is these companies are tremendously profitable. In 2000, people were buying ideas, right? They'd say, hey, you have a domain and you have an idea and a business plan. Regardless of whether or not you have any kind of proof of concept, we're going to throw capital at you.
Yeah.
That's not the case with these. These companies are making more money today than any company has ever made in the history of planet Earth. And so the profitability is absolutely there. So for these AI companies, the Googles, the Amazons, the Metas, et cetera, the question isn't as much, hey, are these companies viable and is AI going to be a transformational technology? I don't think there's a lot of debate around that. It's, are they priced appropriately for the future earnings that they'll have? And that's where things get pretty muddy. To your point, Paul, with this particular slide, we're calling out NVIDIA here, and this isn't intended to be a commentary on NVIDIA one way or the other, but it is, it illustrates an important point. NVIDIA's market capitalization is $4.54 trillion. And so what that's saying is the worth of NVIDIA is almost $5 trillion. So what that's saying is the current value of all future anticipated earnings from NVIDIA are at that level. For perspective, if we look at the annual output of some of the largest economies on Earth, that is almost as large as Germany's annual economic output. It's larger than Japan. So what we're saying with that valuation is this company's current value is worth the entire economic output and more of a country like Japan and almost that of Germany. And that does raise an eyebrow, right? That does say, hey, even if this is a great company and even if AI is transformational, can this be sustained, and are these valuations grounded in reality?
Yeah, so I mean, I think it's fair to say that the question isn't whether these companies are real or even real profitable. I mean, I think it's obvious that we can see they're creating something that is being consumed by the marketplace. These aren't just ideas; these are actual, revenue generating products. But the question today would be whether the growth and the margins are sustainable. And so what are the biggest assumptions embedded in these evaluations that we need to be mindful of?
Yeah, so there's a lot built in. So, there's one assumption that prices aren't going to come down materially. And I don't know that that's a good assumption. Is in most industries, as they mature, things become more commoditized, prices come down. You think about, you've used this example before, Paul, when, flat screen TVs first came out, you were paying several $1,000s for a very marginal product. You can go to Costco now and pay $400 or $500 for an awesome product. So in the case of NVIDIA with the with the GPUs and other things that they produce, are those always going to be as lucrative a product for them, or is it going to become more lucrative or less lucrative? And is someone going to replace it with something that's cheaper and easier to develop? The other thing is, at some point we hit our kind of capacity threshold for data centers. One, how many do we need, and then two, these are extremely energy intense endeavors, and how long are people going to buy a lot of energy being siphoned off to data centers, and those are just two of many questions that are in there. But there's no question, just mathematically alone, Paul, the rate of growth can't be sustained, or in short order, NVIDIA would be worth as much as the U.S. economy, which obviously isn't plausible, right?
Right. And the way I look at this is, when the iPhone rolled out 20 years ago, or however long it's been now, the way we did business, the way we, honestly just lived our day-to-day lives, it was different prior to the advent of the smartphone. And it revolutionized the way that we function in our family life, in our personal life, in our in professional life. It was crazy. And I remember at the time, there was all this talk of, well, it doesn't have a full scale keyboard like the old what were those cell phones that had the full scale keyboard? Anyway, they didn't have the full scale keyboard. Yeah. So there was conversation about saying, oh, they'll never be able to compete because the business professionals got to have a full scale keyboard. And iPhone, in spite of all that, revolutionized the way we function today, because the technology was so transformative and helpful in creating a different way of conducting business. So I look at AI with a similar lens, but that doesn't change the risk angle, right? When over a third of the S&P is tied to just 7 businesses, that's concentration risk. And even if we believe strongly in the technology, Scott, there's got to be a temperance, measuring our exposure there.
Yeah, absolutely. And it's been interesting, Paul, over the last month. We've seen kind of a bit of a pullback in the AI space specifically. So this chart shows kind of the purple line there is those top 7 technology stocks that are heavily focused on AI. Last month, they're actually down about 1.5%. Conversely, high quality dividend paying stocks are up over 3%. And so there's, a 4.5 percentage point difference between those two in a relatively short period of time. Now, this could just be a temporary adjustment. This might not be a long-term theme, but at some point, I think we will see a pivot to, other areas of the market. Things won't be as concentrated in this space. And I think it does, investors extremely well evaluate the size of their tech and AI exposure. And we believe that investors should have exposure there, but you want to make sure it's right sized.
Absolutely. Absolutely. Scott, walk us through this next slide.
Yeah. So, concern number one that you mentioned, Paul, is like, hey, are we overvalued in the AI space? That's one of the reasons for the angst that people have. The other one is, hey, on the inflation front, we're not out of the woods. You hear politicians, of all stripes talking about the affordability crisis, and things are more expensive. I did some math, Paul, prior to our meeting. Any guess on how much more expensive things are today on average than what they were 5 years ago?
It's just be anecdotal, right? You go to the Costco and get a gallon of milk. So, 10% higher.
So 24% higher on average. Pretty wild, right? So,
Yeah.
And certain things are higher than that, certain things are less, but on average, just the average run of the mill good or service is 24% higher today. And people are feeling that in spades. And so even though the economy is going up and the stock markets are going up, if you're trying to buy a house, if you're trying to go to a grocery store and buy food for your family, things feel extremely expensive right now. So this is a considerable source of concern for people. And we're not necessarily out of the woods here. As I mentioned, the tariff discussions, the realignment of global trade is still very much up in the air. On the one hand, innovation like AI can drive prices down. On the other hand, upsetting global supply chains can push prices up. So we'll see in this coming year how that all kind of shakes out.
And Scott, you wrote in your CIO Insights this month, you used an analogy comparing the economy to the human body. I'd like to ask you to expand on why a single policy decision rarely produces kind of clean, predictable outcomes.
Yeah. So economics is disparagingly referred to, Paul, as the dismal science. And it's called the dismal science because it's not like physics or chemistry where you have these hard and fast rules that are very, immutable and can't be changed. And you can kind of, set your watch by it. Economics isn't like that. And so a lot of economic policy, there's research done around it, and you have high confidence levels about how things should happen in a vacuum, but nothing truly happens in a vacuum. Our economy is super complex. It's integrated with the rest of the globe. And so changing one variable will have impacts, but not always the impacts that one might expect. And so we can say in a vacuum, for example, Paul, that tariffs aren't good, and a lot of economic research kind of supports that. But it's happening within the context of 1,000 other things that are happening. And the analogy I used is if you have a healthy individual, great genetics, healthy lifestyle for the most part, gets good sleep, gets good exercise, has a lot of things going in their favor. However, they smoke a pack of cigarettes a week. That person, if you pulled their labs and kind of looked at their overall health picture, it might still be pretty positive in spite of a behavior in there that is suboptimal. And that's kind of how I would frame a lot of the tariffs and not tariffs exclusively. I've picked on those. Any economic policy that's suboptimal, politicians will say, "Hey, the economy is going great, therefore my policy is a great one." The economy might be doing well in spite of the policy because it's a complex system. So
Yeah.
someone might say, "Hey, I'm healthy as a horse and I still smoke." You would be more healthy if you were not smoking, and so that's I think the parallel there.
Who was the famous actor that lived to be 100 and smoked a pack a day?
I think it was Dick Van Dyke, wasn't it?
No, it was something Burns. What was his name?
Oh, I
Anyway,
can't think who that was.
yeah, our clients will know, and right now they're screaming at us. It's something
Yeah,
Burns.
no, I think Dick Van Dyke had been a smoker, stopped, and as a result had some longevity. But yeah, there's another one who just kept going throughout their life.
And I mean, he would jokingly say like, this stuff's keeping me alive. But obviously, the point here is the economy's complex, and there's a lot of complexity that leads to various outcomes, and it's hard to put a finger on one thing and say, hey, this is what's driving this. Politicians always take credit for when the economy is doing well, and will always point fingers at the opposition for when the economy is not doing well. And I think it's just a way to score political points. So talk to us, Scott, about these two inflection points here.
Yeah, so this is another source of concern for people, and that's the kind of state of governance overall with the U.S. as far as we see things like government shutdowns and the inability of our government to kind of coordinate efforts and the deep polarization, and so that's kind of one aspect. The other aspect is parties of both stripes have expanded the national debt significantly on their watch. And so this chart right here, Paul, shows the overall national debt. Right now, it's over $36 trillion. But there's two inflection points or 2 points where the rate of change expanded significantly. And I want to call both those out. So the first one is when we had the global financial crisis happen. When that happened, we had liquidity shocks. Capital markets froze up. There wasn't commerce wasn't being done. And as a result, policymakers poured money into the economy to kind of get us out of that crisis. The problem is once we got out of that crisis, they didn't slow down their spending. They kept spending as though the crisis hadn't stopped. And that continued all the way up through COVID. When COVID hit, that was obviously another inflection point where with the economy shut down, huge stimulus was poured in to keep people solvent. And again, problem there is once the crisis had passed, the spending didn't necessarily drop off. And so we have this situation where not only is the absolute number or absolute amount of debt a serious problem, it's not abating. It doesn't seem to be slowing down. And we're also facing some pretty big demographic headwinds where we have many more people retiring than those entering the workforce. And so this is, kind of an albatross around the United States neck. Other developed nations aren't dissimilar. If you look at, Japan, if you look at Western Europe, if you look at kind of the Western world generally, debt levels are through the roof. and we worry about a future day of reckoning. And it might be in 1 year, it might be in 10 years, it might be in 20 years, but the rate of debt isn't sustainable. And at some point, there will be a reckoning there.
One of the ways that we talk about, getting ourselves out of this debt crisis is taxation, and people worry about, obviously, we got to figure out a way to tax ourselves out of this. One political side will argue that's not feasible. So then we look at interest rates, and can we inflate our way out of this with interest rates? And interest rates are always top of mind. How much influence does a Fed chair really have versus kind of the broader market?
Yeah, so great question, Paul. And as far as the Fed chair, the answer is quite a bit. The Fed chair has a significant influence on kind of the economy overall. The Fed chair does not operate in a vacuum, though. There's an open market committee, and they're the ones who set interest rates. His is one vote on that committee, but he kind of guides the tenor of the discussions that they have. So what the Federal Reserve does is they set kind of the baseline rates of inflation, and then a lot of interest rates in the economy kind of stem off of that. And so if the Federal Reserve lowers rates significantly, that's going to put more cash in the economy. More cash in the economy is kind of juices economic growth. If it juices economic growth too much, that becomes inflationary. So you have some Fed chairs who are what they call hawks, who are very on guard against inflation. You have others who are doves, who are more willing to have super low rates and kind of let the economy rip, but aren't as worried about the potential impacts of inflation. And this is relevant, Paul, because in the headlines today, and this has been kind of a running battle for a long time, Fed Chairman Powell and President Trump have had a running battle. And the most recent development is, the bringing of charges by the government against Chairman Powell, and the potential, kind of politicization of this space. And so investors are concerned about this because they want a Federal Reserve who objectively sets monetary policy based on kind of inflation concerns and not on political influence. And so that's why that's been front and center. So this will be a key driver in the coming years. What we might see, Paul, and this is something that I keep a keen eye out for, is if ever we start to see a big separation between what the Fed's doing and what actual interest rates are doing. Because if there's a kind of a disconnect between those two, what that means is the Federal Reserve has lost credibility.
Yeah.
And people buying U.S. debt are saying, hey, we don't care what the Fed does. We don't like U.S. paper. And for us to buy it, we're going to have a lot better interest rate than what you guys are giving us. And if we get to that point, that's pretty concerning, because the Fed at that point has lost control of the reins, and we have, kind of bigger problems at that juncture.
So in that vein, kind of this slide is illustrating where interest rates are at today and where they likely will be heading. And so walk us through, Scott, kind of the Fed Watch tool and where we are today with rates and where we're likely dropping.
Yeah, no, thanks for kind of setting that up, Paul. So the Federal Reserve sets kind of those baseline interest rates, as I mentioned, and right now that rate is set between 3.5% and 3.75%. They kind of target that range. And what this probability chart shows, it says, based on futures contracts pricing, what do market participants think is going to happen with interest rates in the future? And so the Federal Reserve meets on the 28th of this month. There's a 95% chance they keep the status quo. In March, they're going to meet again, 78% chance they keep the status quo. April, 65%. By the time we get to June, however, there's only a 35% chance they keep the status quo. So in all likelihood, we see a June cut. And then if we kind of carry that forward, we would likely see a cut in October as well. So right now the market's pricing in about 2 interest rate cuts. And barring kind of unforeseen other issues, all things being equal, this will be stimulative to both the economy and the stock market. Lower interest rates will help out, provided that disconnect doesn't arise where the Fed's lost credibility and market participants require higher interest rates. If we don't kind of hit that threshold, this will likely be a good tailwind for the economy and for markets.
And so we don't obviously know this to be a fact, but right now the economy's betting that by the end of the year we'll have rates hovering between 3 and 3.25. And it is a good reminder, Scott, with the commentary we're having here, that lower rates aren't automatically good, and higher rates aren't automatically bad.
Yeah.
What matters is why rates are moving and how prepared our clients' portfolios are for those different paths. And so obviously, if what's driving rate movements is inflation or artificial, persuasion, could actually have a big input, a big impact on and a detour as to what we might do in a client's portfolio, with finding those more secure fixed sources for retirement safety and security. So Scott, let's round out this conversation talking about kind of geopolitics, and how those potentially impact markets.
Yeah, no, this Paul is perhaps the thing that's leading the most to some of the unease that people have in their minds, because the world is a chaotic place. The world's always been. Go ahead.
Well, no, as you say, geopolitical risk has always existed, to your point, but it does feel elevated right now, and so we got to distinguish between kind of these conflicts that matter economically, but the ones that are also maybe just regional.
Yeah, absolutely. And, geopolitical conflict's always been with us. The data that I've looked at, the research that I have, does indicate that, quantitatively it is higher today. It's not just our gut feel. Things are more chaotic today than what they felt historically. And as we look across this map, this kind of, scatter plot here shows different conflicts in different areas of the world. If we start in the Americas, we obviously have the stuff going on in Venezuela. While that one does have some impact in global energy markets, it still kind of falls under the threshold of being a more regionalized conflict, although they're allies with, the Iranians, the Russians, et cetera. Economically speaking, it's more regional in its impact. As we go to Africa, as we go east, a lot of Central Africa in particular is in a state of civil war, which is tragic on the human front. From an economic perspective, not a huge impact there. If we look at the Middle East, you'll see a cluster of dots around the Middle East, and there's a lot happening right now. The Middle East is in a profound state of change right now. The protests in Iran are front and center. From an economic perspective, the impacts to the energy market are the most important things. As the U.S. has established energy independence over the past several decades, this isn't as impactful as it was, say, in the 1970s, where we got nearly all of our oil out of the Middle East, and conflict in the Middle East was something that was, super vexing on energy markets. That's not as much the case now. So that one still probably falls under that kind of regional label that you mentioned, Paul. Russia, Ukraine, that is, somewhat, I guess, regional in nature, but I would say we've kind of moved up a tier as far as potential economic concerns. This year will be really telling with that conflict, whether or not it continues to grind on, or whether there's some kind of peace or armistice that's declared. The bigger concern with Russia is, by all accounts, Putin has global ambition, and the kind of renaissance of the USSR would be kind of his ultimate goal. And so he's doing things to kind of test NATO's resolve. There's drone incursions into NATO countries in Eastern Europe. There's a lot of other stuff going there. And so the concern is, would he ever invade an Estonia or Lithuania to test the resolve of NATO? And if NATO's response is aggressive to that, we're in a pretty significant conflict at that point. And so given the depletion of Putin's resources in Ukraine and how poorly that war has gone for him, that's probably not an imminent thing, but I wouldn't discount that. Many people discounted his invasion into Ukraine. Many kind of thought there's no universe where this happens, yet it did. And so I think it'd be unwise to kind of sleep on that possibility.
Yeah.
Finally, Paul, I think it's worth mentioning, kind of China, Taiwan. We've seen a rapid escalation there. I don't know that we'll, and this has been something that's been on people's radar for 20 or 30 years. So nothing too new from that perspective, other than the tensions continue to escalate. China continues to get more and more capable militarily and more able to affect something in Taiwan if they wanted to. And we may not see a full-fledged war from that perspective, but we could see a blockade. We could see, kind of a limiting of goods and people coming in and out of Taiwan. We could see other efforts to really coerce the Taiwanese government to fall in line with China.
So I guess my question, Scott, just thinking in terms of like our clients who are on this call with us today, you listen to all this commentary and you think, oh my goodness, like the world is coming to a speedy close. And yet, we continue to move forward. And so how do we prevent geopolitical headlines from pushing investors into emotional decisions?
I think we kind of have history as our guide in this space, Paul. And a lot of times for geopolitical conflicts, if it's not one that's going to be truly global in nature, if it's more regionalized, a lot of times there's what I call like a tennis ball effect, where there's a sharp drop and then a sharp bounce back. It's very short in duration. If it's a more global, conflict, we will see, bigger impacts, but economies still grow even in kind of war environments. This table that we look at here shows how markets have fared in different conflicts. And so on average, from the period of 1926 through 2013, markets averaged about a 10% rate of return. That's kind of our baseline kind of number to look at here. If we look at how markets have done during all conflicts over that time, they were actually up about 12% on average during that time. So they actually fared slightly better during.
Isn't that wild?
Yeah, pretty crazy. And the data gets skewed a little bit by World War II because we were coming out of the Great Depression. And you didn't just have kind of the wartime spending, but you had the emergence out of the doldrums of the Great Depression. But nonetheless, it's very possible and very common for markets to still do well, even when conflict is running hot, which is an interesting observation.
Yeah. No, that's very telling, and I think it's important for us to just try really hard to keep our emotions in check as we, consider how the world is working today and how we're supposed to be invested. And I think it's maybe one more nod to concepts like smart investing, where having a well-diversified portfolio is vital, because we can't bet on the end of the world every time a conflict happens, because the end of the world will happen one time, and so you're going to be wrong all the other times you make that gamble, and when it does happen, I'm not sure how much betting on it will actually
probably doesn't matter too much.
Give you a better outcome.
Yeah.
So Scott, if investors only took one action in response to everything we've discussed today, what would you want it to be?
Yeah, if it was just one, Paul, I would say take a hard look at what you own in your portfolio. So lift up the hood, look in your portfolio, and get to the bottom of what you actually own. Some people will think, hey, I own 3 different funds, and by virtue of having 3 different funds that own a ton of different stocks, I should be good. We'll see situations, Paul, as you know, where we'll look at someone's 401k that we're not managing, and they'll have a technology fund, they'll have a Russell 1000 growth fund, and they'll have the S&P 500. And when we do the analytics on the portfolio, they have 43% of their portfolio in 7 stocks. And they have maybe the wrong assumption in terms of how much diversification they have. And if we did have a big tech pullback or other reverses in the market, they might be carrying a lot more risk than what they think. And there's many different things I think to consider for 2026. But the number one is knowing what you own.
Yeah, and I think, to that point, Scott, markets don't require perfection to succeed. They'll require discipline. And historically, like you pointed out at the beginning of the podcast, markets end the year higher about 3/4 of the time. So the real risk isn't volatility per se. It's being overly concentrated or under diversified or misaligned with our time horizons. And that's why, now, not based on the next big headline, the next big scary thing. Now is the time to review our risk, review our diversification, and kind of align our expectations appropriately with what we're hoping to accomplish in retirement and where we're at. So we'll end the podcast there. Scott, great commentary, great insight. Appreciate all of our clients for jumping on today. Until next month, everyone, take care.
Thanks.